So we're going to start the second half. Nick is a founder who has been in crypto for a long, long time. He started his career not in crypto, one of the first employees at Benefit. And Nick lives in Florida, so he flew up here to meet with you guys and talk more about this company, which is a really cool company that I think touches upon everything we talked about in class today and more. So I'll let Nick take it away.
Awesome. Good afternoon, everyone. Thanks, Hida, for having me. Thank you guys all for being here. My name is Nick Garcia. I'm the founder and CEO here at Fortunafi. We focus on tokenizing traditional capital markets assets and doing on-chain securitizations and partnering with different DeFi protocols and stablecoin protocols in particular to create more attractive capital sources for their different use cases. I'm also a general partner at Spacewell Capital, which is a venture fund and hedge fund in the crypto space, which was started back in 2018. I added my email here. If anyone has any questions or wants to contact me afterwards, please feel free, and Twitter as well. And if anyone has any questions throughout the presentation, please just throw your hand up. Feel free to stop me, and want to make sure you guys understand this. So to kick it off, we're going to talk about real-world assets, what and why. We're going to go through a little definition, a little bit of history. We're going to talk about the real-world asset opportunity. We're going to go through the real core aspects of supply and demand, which are really what's growing this opportunity here. And then we're going to talk about this bridge of bringing real-world assets on chain and how that works. We're going to talk about how we specifically do it at Fortunafi. We're going to talk about some of the risks in the space that are sort of present and currently blocking this growth and how we're mitigating them. And if we have time, I'll go through a very complex graph that shows the crypto banking system. So kicking it off here, isn't crypto all about decentralized assets? Why are we talking about RWAs? I think it's important to kind of understand sort of an initial trajectory of where we came from and how we got here. So we started with decentralized money. After Bitcoin, we had a huge innovation in the concept of proof of stake, which is something that people at the time, were very against, especially Bitcoiners, but ultimately turned out to be Ethereum. And what is Ethereum? It's a decentralized smart contract platform, which means there's a lot of different things that can be done on that. And with those two core foundations, everything else in crypto started growing, right? So the next phase was a little bit of ICOs, which we can forget about for now, but really decentralized finance was the next main value driver in crypto. When we started developing decentralized finance, it sort of happened in parallel. But with decentralized money being so highly volatile, there was the need for stablecoins, right? Like, how do we start transacting and doing financial services in a world of highly volatile assets? Stablecoins were born. With stablecoins, you had decentralized stablecoins and decentralized stablecoins. And naturally with stablecoins, as they grew, you started to see a massive divergence between centralized stablecoins and decentralized stablecoins, which is ultimately what started to create the first real demand for real assets. So if you look here, right, I mean, this chart obviously extends. It's just the data is not as perfect when you go further back, but this shows the picture, right? Historically, yields in crypto were really high, right? This is because the market was smaller, there were higher risks, there was, more fear effectively, which caused the premium to borrow stablecoins to be a lot higher. And generally, the cost to borrow and lend on chain was higher. The yield that you can earn from these protocols were higher. Some of them were just inflationary yield, but true yield started to decrease. Anyone have a sense of why this dynamic is happening? Why are DeFi rates going down while treasury rates are going up? There is effectively a complete opposite correlation between on-chain yields and off-chain yields. It's not actually, they don't affect each other like that. That's actually not why. There is a concept of bull and bear markets, right? In bull markets, money's cheap off-chain. In bull markets, what do people do on-chain more? They're trading, they're borrowing, they're getting liquidated, they're launching new projects. Yields are higher because products are being used and people are paying more to utilize products. What happens in a bear market? People stop trading, people stop borrowing, people stop taking risk. So natively, yields go down. Yida touched on this earlier. Most borrowing rates in DeFi are variable rates, and they're based on a utilization curve. So what that means is if there's 100 million DAI supplied to a market, and a utilization curve says, if up to 80% of this collateral is borrowed, the rate is here, and it basically slowly curves up, and then it hits a certain point, like 80% or so, where it just spikes up dramatically. And that's just a function of demand, right? So as people are borrowing USDC out of Aave, the variable rate goes up, which is a bull signal. So ultimately, we went into a bear market. The US started hiking rates. It's continued to create more of a bear market, and you start to see this dichotomy. This was one of the first main reasons that RWA started really coming on chain, because the yields on chain started becoming so unattractive that people are not going to bring them off chain to come on chain. And there's a lot of different reasons for this. Let's go to the chart on the right. Anybody have an idea why the red one is so low compared to the other two, three? Well, the top one is all stablecoin volume. So why is DAI so much smaller than USDT and USDC? So DAI is backed by, originally it was Ethereum, then wrapped Bitcoin and a couple other digital assets, then LP tokens, now RWAs. We'll get there in a second. The other ones are all backed by dollars. There's a infinite amount more of dollars outstanding than there are of crypto assets that are lendable or borrowable against. The reason that DAI is that much smaller is there's literally not enough crypto assets to mint enough DAI stablecoin to match the other centralized stablecoin issuers. See where I'm getting at, guys? This is like a problem, right? Decentralized stablecoins, we can get into this theoretically, but they're actually a lot more efficient than centralized stablecoin issuers. And they're better for users for a few different reasons. But the core reason that decentralized stablecoins have never gotten to the level of centralized stablecoins is because they have historically only been reliant on digital asset collateral. And that's another core reason that RWA has started really coming into focus. Before we get into all the technicalities, let's define RWA. So real-world assets, which is actually a bad name for real-world assets, I will say. It's actually risk-weighted assets. That's what RWAs are. So a lot of like traditional financial people don't really like RWA, but it's stuck, and that's what we're going with. So real-world assets. They are assets that exist in the real world, like asset-backed loans or US treasuries, connected to digital tokens on a blockchain. These tokens represent ownership and allow these real-world assets to be part of the decentralized finance system. There are a lot of different approaches to tokenizing real-world assets. We fundamentally believe that there is core value in bringing traditional financial assets onto permissionless blockchains because you're able to compose these assets across so many different platforms and use cases. It creates a huge form of distribution. It allows people in other countries that don't have access to access these and sort of creates more attractive yields for protocols in DeFi, as we've seen in the last slide with these yields going down like this. I'll just touch on a couple really main sort of key points with RWA. So this starts in 2019. Before 2019, there was actually a push for RWA during the ICO season. People were trying to do tokenized stocks. They were trying to do tokenized equity. None of this worked. All of it failed. Why? The answer is because there really wasn't demand that was built back then. As DeFi started maturing, this demand started maturing. As stablecoin started scaling, this demand started to really materialize. Since then, though, we've had Société Générale, which is a bank in France, issue $112 million worth of bonds on ETH. They also did another issuance that same year. In 2020 is when things started getting really interesting. MakerDAO, for the first time, approved a DAI vault backed by real-world assets. We were the second one to be approved with MakerDAO. After that, there's been a lot of sort of developments, but Société Générale has been very active. MakerDAO's continue to onboard several different pools, primarily on Centrifuge, which if you guys want to get into the technical reason there, we can. But really, Centrifuge was a securitization layer built more specifically for stablecoins than some of the others. There's been gold-backed stablecoins. There's been a lot of treasury developments on chain, like with Ondo that you've pointed out. Vera Labs is another one that's sort of tokenizing carbon credits, and there's other models of tokenizing carbon credits like the speaker you guys had a couple weeks ago. And there has been a significant larger amount of developments here. Just actually over the last quarter, BNY Mellon, the World Economic Forum, HSBC, Northern Trust, and this list just goes on, have been talking about real-world assets, have been bullish on real-world assets. They're talking about predictions in real-world assets. On the left-hand chart, on the left-hand side of the slide, we have a chart from BCG. So BCG was the first institution that actually put together a research report to quantify what the opportunity is to bridge traditional financial instruments on chain. They basically got to 16 trillion by 2030. We did the exact same exercise with our own methodology and got to 30 trillion by 2030. Citibank just recently put one out like a couple days ago that's even higher than that. I'm not even sure what the number was. But what you can see here that I find is interesting is they broke out some of these different assets, right? But here you see, this year I think we're already very close to topping this 600 million of assets on chain. I know Maker actually, I just recently did this analysis, they have some like 750. So we've already beat the 2023 numbers. But this spans, listed equities. These are publicly traded equities, unlisted equities, private equities, startup equity, other types of equity that are not publicly traded. These are investment funds as well. These can be bonds, home equity, mortgages, and a number of other financial assets. The first asset that we started with is revenue-based financing. In my perspective, because this market is still maturing, it's a lot easier to bring lower maturity assets, lower duration assets on chain, right? So we focus on sub 3-year maturity assets. Obviously, there's 30-year mortgages. They're great products. There's massive mortgage securitizations, but blockchain hasn't even been around for 30 years, so imagine a 30-year asset on chain right now. Eventually, we will get there, though. So I think it's really important to talk about both sides of the market here. So supply and demand. We're going to kind of unpack this a little bit. So on the left-hand side, you have the market of traditional financial institutions. SVB no longer. I probably should have updated this slide. But there's different issuers of corporate debt. BlackRock is one of them. Asset-backed loans, there's a massive market. Jefferies is a big player there. Blackstone is a big player. Recurring revenue advances is what I was just talking about. Pipe is actually one of our current partners. And Stripe, they do advances against their own merchant revenue streams. And why are all these borrowers interested in this? Does anybody have an idea why any of these institutions would want to borrow from on-chain capital? It's actually a cheaper cost of capital, and we'll get into this why. And it's actually a cheaper structural cost, right? So a lot of these traditional warehouse facilities are put into warehouse facilities. So you have a lender that basically pools these together, and then they create an instrument and sell it down the road. What we're effectively doing is doing those on-chain, and it's significantly cheaper to do an on-chain securitization than it is to do an off-chain securitization. And we'll also get into that in a second. So clearly there is a substantial amount of demand from institutions to have a cheaper source of capital, also an alternative source of capital, because on-chain capital is uncorrelated to off-chain capital. So for example, like the markets can crash, banks will cut your line, MakerDAO is still functioning because they're not directly related. So that's on the borrowing side. For example, we have over $2 billion of demand from borrowers. So there is like an obscene amount of demand on the borrowing side. The bigger issue has been on the demand side, on the liquidity side. We fundamentally believe the biggest source of demand is functionally with stablecoins. There's also a chunk of demand that comes from P2P lending, so effectively permission pools on chain. This is what Maple Finance does. This is what Goldfinch does. This is what Aave Arc does. It's effectively a permission pool that will receive stablecoins and deploy it out. They're less efficient. They're not cheaper, but they're a little bit quicker to set up than more permanent capital on chain. The stablecoin should be having minimum liquidity ratios, which are effectively equity in a stablecoin protocol. Like how much equity and capital does a stablecoin actually own outside of user-provided capital and user-issued liabilities, which is the stablecoin. They fail. They fail if they're not set up properly. They get depegged. They get arbitraged. They get flashed, and they lose all their collateral in their treasury, which is pretty much a simplified version of what happened to UST. So demand is through the roof from traditional institutions. What they're trying to figure out is how to take advantage of this. So what we've learned from a lot of these institutions is they want to continue selling their products to their customers, but they don't necessarily want to be exposed directly to public blockchains, right? So naturally there's an opportunity for an intermediary there that is able to provide value to their customers. So what a lot of these guys like Goldman and Fidelity and a lot of these guys want to do is they want to sell these products to their customers and allow their customers to get some additional benefit, be able to borrow against that asset, be able to invest in something else with that on chain, right? So there's a few different examples of that, and also sort of getting direct capital from these structures. Let's talk about the stablecoin side. What I have here on top is a breakdown of the MakerDAO collateral types, bucketed broadly between stablecoins, DeFi tokens, and real-world assets. 3 months ago, this was actually very, very, very different. It was something like 80% stablecoins, 13% DeFi tokens, and I think it was 1% RWA assets. So the existing breakdown of collateral for MakerDAO is 50% stablecoins, so USDC, USDP, Paxos, and GUSD, I believe, are the three that they have. There are DeFi tokens, so this is Wrap Bitcoin, Ethereum, LP tokens, which, if you guys are not familiar, is just a token that represents two assets in a liquidity pool. And then now real-world assets. About a year ago, this real-world asset bucket did not exist. MakerDAO was losing money on a net profit basis, and their TVL couldn't grow. Because in order to grow their TVL back then, you needed to actually borrow DAI against Bitcoin or ETH. And again, when you're in a bear market, it becomes very challenging to want to go long on an asset that's crashing. So there was very little demand to mint DAI, hence this really big opportunity. So if you look at the yield per DAI that Maker lends out against these assets, there is a huge difference in how much money they make, right? So on stablecoins, they make 0.3%. Compared to on real-world assets, they're making on average 3.5%, which is a sizable improvement and a meaningful difference to the income that MakerDAO actually generates for the protocol. So clearly we've seen here Maker has gone from a negative P&L to a positive P&L by taking literally 14% of their balance sheet into crypto assets. MakerDAO could put a lot more into here if they build products that created term for their stablecoin, like a zero coupon bond or a coupon bond or sort of a few other mechanisms that exist. So what are the main benefits to stablecoin issuers and DeFi protocols? You get diversification of collateral. These collateral assets aren't correlated. This was a big issue with Luna. Bitcoin, ETH, and Luna were highly correlated. So you short the whole market. Luna has no more collateralization. Higher yield and capital efficiency. There's less of a LTV requirement for real-world assets because of the existing and predictable default rate, unlike the variability of prices in crypto. There's an aspect of risk management and reduction of systemic risk because it can buffer against crypto market volatility, which is what I was just talking about, and then it provides a lot more liquidity, right? So if Maker was able to, double, triple, quadruple this real-world asset exposure, that DAI line from here would actually start really hiking up. So I want to kind of go through the bridge of bringing these assets on chain, and then we'll go through the exact mechanism to do it. So the way I think about this real-world asset to DeFi bridge is 4 main layers. So at the top, you have your first layer, originating, underwriting, legal. This is your centralized legal counterparty to institutions. This is what we do at Fortunafi. We abstract everything for the institutions, and we abstract everything away for the stablecoin issuers and the protocols. Beneath that, you have what I think of as like the securitization layer. Similar to like AWS for startups, for RWA assets, you need some smart contract to securitize these assets. We currently are live on Centrifuge, but there's also Credix, which is a great team, also Goldfinch and Maple, which are doing this, a little bit of a different angle. Goldfinch, for example, is focusing on Latin America. Maple's was focusing on under-collateralized loans, which is effectively loans to market makers. And then Centrifuge, which is really focusing on these securitizations and connecting it with stablecoin issuers like MakerDAO. Then you have the 2 liquidity layers. So you have P2P liquidity, which is very similar to P2P lending in fintech's early days. It didn't really scale, but it was the first mechanism for liquidity for these projects. So you had Aave Arc, which was a permission pool on Aave that spun up. All of these protocols on the layer 2 also have their own permission pools. So even for our pools, we have a permission pool that an individual investor can get KYC, AML, and invest in. But again, our focus is really with the centralized stablecoin issuers. The 4th layer here is the balance sheet layer of crypto, which I use the example of MakerDAO, but I can guarantee you there will be numerous additional protocols that are developed and launched here over the next year. But really, this is where we think is the true balance sheet of crypto. This is where these assets will likely sit and be behind a more stable asset that can provide more utility to their users. Any questions? So how do we actually bridge these assets? So again, we do the origination and the servicing. We have multiple different originator partners, and we bring each of these assets into a similar on-chain securitization. So revenue-based financing assets across multiple originators will go into a revenue-based financing pool. Commercial real estate assets across multiple originators will go into a commercial real estate pool. These assets are actually sitting in a legal entity. The legal entity is directly reflected on chain. So the way that we bring these on chain is you create an NFT that represents your pro rata ownership of that legal entity that holds that underlying asset. That NFT is then pooled on chain, and the smart contract of the securitization reads the NFT and the collateral values, and it creates the senior and junior tranche of the securitization. So let's say we're creating a $10 million facility and the institution is borrowing $5 million down from it. We would mint a $5 million NFT that represents that $10 million facility, which is being held by that SPV. And then that NFT would get used to create the senior and junior values. And the senior tranche is automatically used to create DAI with MakerDAO. So all these smart contracts are interconnected. This is the beauty of it. It happens immediate. We are literally creating the money that we are using to lend out. So like in the traditional finance world, a lot of these originators, they have a warehouse facility to actually purchase and fund these assets. And then they actually have a takeout facility. So they're balance sheeting these assets with one credit facility and then they're selling it off to someone else to not keep it on their balance sheet. That's two sources of capital to fund one asset and multiple counterparties. Again, there's just multiple counterparties in the traditional finance segment here. In this world, it's direct, right? So we immediately create the DAI. So it's new DAI in existence that is converted to dollars and then lent out to these institutions. So with that example, the $5 million facility, we would get $5 million of DAI created. We would swap that one-to-one to USDC through Maker. They have this concept called the PSM. It's the price stabilization module. It's a stablecoin swap function, whoever was asking about swaps earlier. And then we get USDC and we redeem it through Circle to get USD, and that's what's actually wired out to these institutions. So the institutions get dollars. They're facing traditional legal entities, and they know that it's connected with crypto, but they don't need to know, and they frankly don't care. How do you actually prove the custody of the asset? How do you actually transparently get the cash flows on chain? How do you actually transparently prove the mark-to-market of these assets on chain? We've set up third-party custodians on the custody side. So we have third-party, 100 billion plus institutions that are custodying our assets. They're also acting as payment agent. So they receive all the underlying cash flows for all the underlying assets, whether they're publicly traded or not. And they receive them, they run the waterfall, and they send it directly on chain. So we don't touch the assets, we don't touch the cash anymore. The third question, which is what you were getting at, is how do you actually prove that valuation? So what happens in the traditional world, securitizations do roughly like a quarterly mark-to-market. So they run a waterfall, they look at defaults, they look at the cash flows coming in, and they create a NAV, effectively, like a net asset value of the pool of assets. We're doing it on a monthly basis. So our custodian is running this waterfall on a monthly basis, and effectively auditing this value of the net asset value, and then sending it to a third-party auditor that then receives that and sends it on-chain to Chainlink.
Okay, who's that third-party auditor?
It can be auditors like Deloitte, Grant Thornton, several others that are frankly not doing it as much anymore after the whole FTX debacle. You can also, this is not who we're using, but as an example, like DeFi Llama, right? DeFi Llama is like a third-party technology provider to the crypto space. They can have a role as a service provider to effectively receive data from a third-party custodian and then attest that on-chain, right? They basically receive the data and they send it. Make sense?
Yeah.
So Chainlink, we're actually working with Chainlink. So Chainlink will absorb all that data from the real-world asset partner on-chain, and then it will also take all the digital asset value as well. So we have one oracle that will prove the correct mark-to-markets on all the assets in the protocol. And this is something that we're doing for other protocols as well. So this is like, Maker has a hard time with this right now, right? They trust all these different counterparties like us to tell them what these things are worth. So we're building a solution here that allows protocols to adapt our oracle to update their proof of reserve. Right. So one of the issues, all the protocols are trying to launch proof of reserves to show that they're transparent, to show everything. It's to not have some of these issues that happened last year. But how do you do that with real-world assets? That's actually a big issue. It hasn't been solved before. This is currently the best implementation, in my opinion. But I think there will be also new technology there that will also create alternative solutions. Exactly. And honestly, the bigger issue, because we went down this path, is PwC doesn't want to do this. Yeah. They're afraid of doing this for the same reasons that the institutions are afraid to directly, interact with public blockchains. There's a lot of auditors that got tied up with the FTX thing, and others that just have a bad look now. So like effectively what we're having this third-party custodian do and what we're having this third-party auditor do effectively can be done with smart contracts as well. But there is a certain point of input that data needs to be trusted, but then it basically audits the process and it tests that the process was done correctly. So not just the calculation, but the process that led to the calculation. So there will be like advancements on technology that will create more efficient solutions. But right now this is the most scalable way to do it that I've discovered. So last slide. It's a doozy. It's a big one. This was done by the very brilliant Sebastian Devereaux, who used to lead Real-World Assets at Maker. He now runs protocol economics for us here at Fortunafi. And this is an attempt to create an image of how all of this interacts together. So if I'm going to start on the very left-hand side, who are these borrowers? We talked about them. They're individuals and households. They're small to medium-sized businesses, corporations, governments, etc. I think that's a pretty understood segment. Then you have, this is the off-chain to on-chain sort of banking system. Then you have people that are securitizing these off-chain assets. That's what we're doing at Fortunafi. There's folks that are specifically focusing on public market tokenization like Ondo, and that's how these assets are coming on-chain. You have the crypto markets, which you have DEXs, money markets, which are effectively borrowing and lending protocols like Aave, speculators and arbitrage that are utilizing these assets. But where they ultimately go is they sit on the intermediary's balance sheet, which is stablecoins, money market funds, and fiat-backed stablecoins eventually. And where does the money come from these stablecoins? It's ultimately real-world lenders as well, right? It's households, institutions, sovereign wealth funds is the last example. But effectively, a lot of the same borrowers are the same lenders, and it just ties it all together. That's all I got for you guys. So if anyone has any questions, I'm all ears. But thanks for having me. Appreciate it.